Hi everyone, my name's Emma, founder of The Broke Generation, and I am on a mission to help people feel good about money, life, career, and being a grown-up. I've teamed up with Credit Union SA to take you through the basics of lender's mortgage insurance when buying your first home. We'll go through what it is, when you pay it, why you pay it, and the difference between paying it and avoiding it. So let's get started. LMI is a term you'll probably hear thrown around a lot on your home buying journey. But what does it actually mean? LMI stands for Lender's Mortgage Insurance. And what many don't realize is that it's not actually an insurance that protects you, the buyer. It's an insurance that covers the lender in circumstances where there's a greater risk that you, the borrower, may not meet your repayments. Okay, so when do you pay LMI? The reason LMI is a hot topic of conversation among first home buyers is because generally you'll be liable for LMI if you want to borrow more than 80% of a property's value. In other words, if you're buying with less than a 20% deposit. When borrowing more than 80% of a property's value, the risk to the lender is higher. That's because there's a greater risk of a shortfall, which is when, if sold, the money from your property sale wouldn't cover the outstanding loan. Now, often first home buyers are encouraged to avoid paying LMI, and that's understandable. It can be expensive. The actual cost depends on how much you want to borrow and how much the property is worth, but it can be thousands or tens of thousands of dollars. Despite that, it's important to consider the costs of waiting until you have a 20% deposit too. With the current average house prices, a 20% deposit often means a six-figure sum of cash is needed to stump up for a first home purchase, and that takes time. That time can cost you money if the type of home you want to buy gets more expensive in the time it takes you to save up that 20% deposit. For example, if you set out looking to buy a $500,000 property with a $50,000 deposit, so 10%, you could be liable for more than $10,000 in LMI. But depending on the time it takes you to save the other $50,000 to make it a 20% deposit, the $500,000 property you wanted to buy could have increased in price by more than the cost of the LMI. However, there is no guarantee that properties' values will increase. The market will always fluctuate depending on a variety of factors, and every property has different variables that impact its value. The other thing to consider is how much it would cost you in living expenses while you save up the remaining 10%. If you are renting in a pricey suburb, staying in your current rental while you save up that extra 10% could also cost you more than the amount you pay in LMI. But if you're living at home rent-free with mum and dad, you might opt to stay put until you are at that 20% mark. When you buy with less than a 20% deposit, there is a greater chance that those market fluctuations could result in your property being worth less than the amount you owe on the loan. Ultimately, there's no one-size-fits-all solution when it comes to deciding between paying LMI or saving a 20% deposit, but understanding where LMI fits into your home buying journey can help you make more informed decisions. The most important things to consider are your own risk appetite, your living situation, your broader financial situation, your lifestyle goals for the short and the long term, and how much you're paying in other fees and duties. To better understand the options for your situation, speak to a qualified home loan professional. Good luck!